if it's worthwhile. And I'm going to go ahead and I'm going to start off at the very top here to say I am not a fan of REITs. And I'm going to give you the reasons, but first I need to describe what it is. A real estate investment trust is a way to invest in a variety of real estate properties such as hotels, office buildings, shopping malls, warehouses. As you can tell, it's a way for the individual investor to be able to pool their money together and invest in a commercial property. Most apartments, resorts, hotels, office buildings are the most common that I've always heard of. There's a price tag of $7 to $10 million on it. And most people aren't going to go out and spend $10 million on an office building to go collect rent. Nor will they take out a 20-year commercial loan or a 40-year commercial lease on the building to try to generate that revenue. So what it is, it's a way for you and I'm going to say middle America, the average investor, it's a way for us to pool our money together and to invest in a multi-million-dollar building. If you look at the picture, right? Investors purchase the shares in the REIT. It's an acquisition or investment. They purchase the building. Rental income, interest, or payments come back to, and investors receive an income. The interesting part is it is a trust. And I'm going to go ahead and I'm going to scroll down here just a little bit because to qualify as a REIT, right? What are some things that have to happen? At least 75% of the total assets gathered. Someone like me would be calling you up and trying to gather your money. Hey, put $100,000 here. We pay 7% yearly. That's kind of what the big push was, right? Well, out of our rent, we have to pay 90% of the taxable income have to be returned back to you for investing in my REIT. Now, there's a couple catches here. At least 10% of the shareholders, you have to have at least 100 shareholders that have joined this trust. If I was to ask you, most of these are run through partnerships. A partnership LLC that's held by a trust. There's a problem with a partnership. And here is big problem number one with a REIT. If you try to get out of it, it is illiquid. If you're one of those first 100 and it's not performing well, or it even is performing well, you can't get out of it that first year. In fact, mostly they want you to stay in it 3 to 7 years. They'll lock up your money. But because it's a partnership held by a trust, at the beginning of the year, you are listed as the owner of that partnership and trust. You could literally lose money, sell your partnership to someone else. The REIT could turn around mid-year and make some money, and you being the registered owner on that partnership that's held by a trust, you would pay taxes on the gains, even though you may have sold at a loss. Taxation, probably the number 2 fear or problem with a REIT. You're going to be taxed on the yearly gain. That's the way they work. I'm going to go back up to the top here, and I'm going to go through when I used to gather funds for REITs. until I better understood it. Let me just list out some numbers for you. Profitability on REITs. Going to do it this way. Is usually achieved at 90% plus occupancy. Payment of, I'm going to call it a mortgage, right? No, I'm going to say payment of commercial loan is usually a break even at around 76% based on cap fees. Building management, electricity, maintenance are all expenses. Can't spell. And delinquency, actually I should say delinquent payments. I need to learn how to spell exactly. Delinquency payments or bankruptcy are the investment risks with your money. So let's face it, I'm going to call it what it is. If you are in a REIT, you have given your money to someone else to buy the property and to hope in 7 to 10 years or 3 to 7 or 5 to 7, 5 to 9, however long you're in it, however long they expect the ability to run the REIT, you have given someone else your money to go and purchase the property, to hope to sell it in 7 to 10 years, to reap the rewards on the appreciation of the property. That is what you're doing. And your expectation is take a dividend from the trust or the REIT that will pay you 7% is on average what you're looking for, that you get taxed as a dividend. The risks, it's not to me. If I've got your money, I got the building. The creators of the REIT, the owners, the 5 people that own less than 50%, 49.9% of the ownership, or the REIT may be written that you only get the interest payments, you do not receive the benefit of property appreciation, but your money is at risk for someone like me to go try to make it big on investing on a commercial building of some kind. If I don't have my 76% occupancy rate at a cap fee that's, I don't know, I'm going to say realistic. Realistic is a general term for every different city, every different metropolis area. It runs differently in certain areas. But if I don't have 76% occupancy, I'm typically not paying, or I'm going to be behind on taxes and or commercial loan payments. If I don't have that 90% plus occupancy, I do not have enough money for management of the building, expenses for the building, maintenance of the building. And unfortunately, the big question is, why would you be getting into a REIT at generational property, how am I going to say that? Property, generational property high prices. I'm just going to make it simple, right? Well, Kevin, I got into my REIT 7 years ago. Well, 7 years ago was awful. In fact, in 2008 to 2013, most REITs went under. Most REITs went under. For people most recently who invested in REITs in strip malls or malls, most of those have gone under. One of the pushes is, hey, we're doing REITs for businesses. In fact, I heard this one recently. We're doing REITs for S&P 50,000 type businesses. Well, it's S&P 500, which are the big ones. 50,000 S&P type businesses. It's just a mom and pop organization, right? If you're invested in apartments, a recession affects how people are able to pay their rent. You're in trouble. If you're invested in a REIT that's resort-based, you're in trouble with the recession. If you're invested in a REIT that is storage units, that's another popular one, you are in trouble. It's this type of financing where you're literally financing someone else, where the REIT is listed, written, operating agreements are all in their favor. You are literally giving someone money to hope that they can manage a commercial property when they could not afford the property themselves. It's scary to see what's out there and what those opportunities are. I gathered quite a bit of information on Investopedia, on real estate investment trusts, just information for you to understand it, different type of REITs that are out there. I wanted to go to the risks. REIT taxes, you still got to pay your taxes on them. Usually it's only 15% long-term capital gains. What are the risks? What are the risks of real estate investment trusts? I'm going to find the risks. All right, so they're saying share value. Non-trade REITs are not publicly traded, which means investors are unable to perform research on their investments. Even publicly traded REITs are based on past performance, not current market risks, right? Lack of liquidity. There's no liquidity for a REIT that's not performing. Non-trade REITs can't be sold for minimum of 7 years. That's usually when people go bankrupt, right? Distributions. They don't have to distribute the money when they say they're going to. In fact, they can take up to 3 years to create cash flow before they start to pay their dividends. Fees, upfront fees, these are front loaded, 9 to 10%, sometimes as high as 15%. It's a great way, again, to fund someone else's opportunity at owning a commercial building, not your own. Interest rate risks, higher interest rates make it harder to borrow money, make it harder for companies with their fixed rate of returns. Most REITs don't perform well in interest rate rises because higher rents are going up. It's fine when you say choose the wrong REIT. There are just some areas that are not going to do well with certain types of REITs, primarily most recently, strip malls and malls in general. Stores have been moving away from them. They say tax treatment. I guess some dividends can be taxed as ordinary income, but more important, it's how you're listed on that taxable REIT. If you are a shareholder, if you're the owner, if you're part of a 500 person partnership that's only held by a trust, your taxes could be pretty difficult. And again, you can get screwed by getting in and out. There are some fraudulent REITs that turn out to be scams. You have SEC compliance on them. And it's just, I mean, the short answer is if you're investing for some type of, dependable income, it's smarter to do it as a long-term treasury bond. It won't pay as high, but those are better protected than the garbage people are throwing out there right now. Most REITs have not paid 7% in the last 10 years. And with the rising interest rate, I guarantee you will see a lot of REITs go under as they're just not profitable, and those buildings get taken back by the banks that loan those commercial loans out to those individuals based on the property values. It is super hard to receive a full occupancy of a commercial real estate office building. It's super hard for most storage units to have enough occupancy to pay their bills and to justify to become profitable. That's the short answer. I know on storage units you need like a 96% occupancy to become profitable. But again, if you're paying someone else's commercial loan off for him building the storage units, when you guys are done, the owners own it. You just funded their ability to create a commercial real estate opportunity. Yes, it's nice when they work. Yes, it's nice when you find someone that's honest. But in real life, there are too many moving parts and there's too much uncertainty in a REIT to truly make it a viable investment. You don't have the expertise for the market to see if small businesses can rent out the office space. Too many businesses have gone under. It's just a truly a scary investment from start to finish. I hope this helps you understand REITs. I'm going to publish it out there for you. It is not an investment I would recommend. I would not feel that it is a good use of money that you would fund someone else's opportunity to try to own a commercial real estate building to allow them to take all the appreciation on it, for them to somehow be able to know when and where and how to purchase it at a cap rate that is profitable for the uncertainties and commercial real estate and basically business rentals. Guys, have a good day. I appreciate you letting me get this out. I will hopefully answer questions on this on Monday. I hope this was helpful to understand a REIT, and I look forward to talking to you guys next week. Bye-bye.